Welcome to the August edition of the 2021 Housing Market Report here in San Antonio. Today I want to discuss with you the housing bubble predictions, the forbearance and what that stands and what that looks like, and of course the San Antonio housing market numbers. I'm Krishna Perkins, and it's always my goal to bring you the best possible information so that you can make the best possible decision for you and your household. Jumping right into it, housing bubble and what that looks like. What do those predictions look like? Number one, I just don't see the housing bubble happening here. But why are people saying there's going to be a housing bubble? Let's look at those numbers. The first and foremost thing that we're seeing that is causing folks to say, hey, we're in a housing bubble and it's going to explode and we're going to have all these foreclosures is the year-over-year price appreciation and how that's accelerating. And understandably, it's huge. So January 2021, this is from CoreLogic, we saw a 10% year-over-year price a percentage of acceleration, okay? And then we saw 10.4% acceleration in February. March was 11.3%, April 13%, and May 15.4%. So just year over year, that's a huge increase, and we had huge increases in 2020. So with 2021, more big increases, and that is really alarming to some folks. Now, if we go back and we look at 2006, the stark contrast here, we did have huge price increases there, but that was a whole different story. We had a lot of subprime borrowers in the market, and that can be anyone with a 620 or less credit score. 2006, there were $376 billion worth of subprime mortgages in the marketplace. Fast forward to 2020, $74 billion. So $376 billion versus $74 billion. Huge difference. Very stable buyers in the market right now. And when COVID hit, I saw the standards for, even borrowers that were above 700 go way up. The lenders started questioning everything. So even now, they started relaxing a little bit, but they're still very strict. They're looking at everything very, very closely. So you can't just walk in and get a loan like you could back in 2006. So the market has a lot of stability in it, and moving forward, that's going to, help keep values higher versus after the crash of 2008, 2009, when we saw so many foreclosures. I want to read a quote from Mark Fleming, and he's a chief economist at First American. Looking back at the bubble years, house prices exceeded house buying power in 2006 nationally. But today, house buying power is nearly twice as high as the median sales price nationally. Many find it hard to believe, but housing is actually undervalued in most markets, and the gap between house buying power and sales price indicates there's room for further house price growth in the months to come. So he's not saying it's going to go on forever. He's saying that there's still more room, and the key factors that are making the housing more affordable is interest rates, okay, and disposable income. Across the board, we're looking at folks. They have money. They have low interest rates versus the interest rates back then, which were much higher, and then the household disposable income was much lower. So people have a lot of wiggle room, to pay their debts and to make these house payments. Especially with the rates being so low. That is why it's more affordable. Okay. Now, with that being said, affordability is continuing to decrease. If we look at the National Association of Realtors, they're reporting that the affordability has been decreasing throughout the year. Now, it's not to the point where it's going to impact prices yet, or market activity yet, but it is continuing to become less affordable as we move forward. And unless wages all of a sudden all go up, we will hit a wall. It won't mean that the housing is going to crash or anything like that. It just means that less people are going to be able to afford the home, so you won't see high appreciation. You'll see lower appreciation, but these double-digit appreciation numbers are going to come down. We'll get back into the single digits, back to something more normal, and it'll still be more expensive to own a home later on, but at least you won't have these crazy multiple offer situations with every single home. So that's something you can look forward to. Now we want to go and look at forbearances. Forbearance is another key factor folks are looking at, thinking, okay, here comes a bunch more foreclosures. 1.8 million was a calculation. Now let's look at those numbers now. The original projection for forbearance, they originally projected that 30% of all loans were going to be in forbearance. Okay, this is from First American Mortgage Bankers Association. So 30% of all loans. That did not happen. It came out to 8.47% of all loans actually went into forbearance. And of that, today, not of that, but 3.5% remain in forbearance today. So, that's a huge difference. We went from 30% to 8.47%, and now only 3.5% are actually in forbearance. Moving forward with that, out of that forbearance, we had 44.1%. They were paid in full. Okay, all the people that 8% that went into forbearance, 44.1% of them were paid in full, and then 38.7% worked out a repayment plan with their lender. So they went in, made some changes, and now they are back on track and making payments with their lender, and have exited forbearance. Now, the troubling number is there is 17.2% that were still in trouble and left forbearance without a plan. So they haven't made arrangements with their bank. They don't, they haven't sold. But on the flip side of that, the good news via Black Knight, which is another data company, reports that over 90% of homeowners have at least 10% equity in their home. So even these folks, 17.2% that are out there, they can still sell their home. They could get out of it if they needed to. They don't have to, go through the foreclosure process and ruin their credit. They can, there are options there. And really, this whole forbearance thing is something that we did not have. This was a tool that we did not have back in 2006 to offer. You had some banks that would do short sales. It wasn't always easy to get through the process, but it was offered. But this was so much more streamlined that we're just not seeing the numbers that we saw back then. I mean, we had over 9 million people that actually went through the foreclosure process, but with these numbers, we're looking at maybe 300,000, 200,000. So it's a stark contrast to yesterday's market, 2008, 2009, versus today's market. We don't want to see folks go through that foreclosure process. So if you know anybody that is in in that situation, or they're in forbearance, or they've left, they haven't made a plan, just tell them to open their mail. There is a loss mitigation department that's probably been sending them mail and asking for them to communicate, and hopefully there's an answer there for them. Skipping up to the San Antonio market, well, we are still solidly in a seller's market here. The median sales price is $280,000. Average sales price $321,000 in the San Antonio area. New listings, we did take in more new listings on the monthly back in July. So that's up 9%. Month supply, we did increase our month supply a little bit. We're at 1.4 months worth of supply, so roughly 8 weeks of supply. Excuse me, about 6 weeks worth of supply, and that's still really low. So we're seeing a little bit of fluctuation in the supply, and this could be just a seasonal thing. We've got people maybe that have started vacationing. We've seen a little bit less foot traffic. I mean, a little bit, but not so much that it has completely changed our market and swung it back to a buyer's market. So I have noticed some price changes in the market, and some big price changes. When I'm scrolling through the market, I'll see a $6,000 drop, an $8,000 drop, $10,000. So bottom line, sellers, don't overprice your home. When I see big price drops like that, it just tells me that you're taking a shot at this a price that just wasn't attainable. Please look at the numbers and make sure that you're getting your house listed properly, because you lose more money when you have to reprice a home like that. Folks start scratching their heads and wondering, well, why such a big price drop? And there may not be any underlying reason for a home to have that price drop, except it's overpriced. So you don't want the buyer's imagination to run wild and think that there's something wrong with the home. So price the house. Let them buyers bid that sucker up. They will. If the house has been priced appropriately for what's available in the home, they are going to bid that sucker up, and it'll feel good to them, because they won the bid. They won. I can. If you, as a buyer, and I've gone through this. If it's your idea, it's great. But if it's somebody else's idea, it's terrible. So let them bid it up. Then they're gonna be a lot more happy with it, and you're gonna be happier because you're gonna make more money. So if you have any questions, let me know. I'm happy to talk, and as always, please be careful out there, and I'll see you on the next video.